Well, we'll talk to January in a couple minutes. I think we'll have some more people start coming in. Or we can even have her back up on stage in the meantime. Avoid that awkward silence. Wow. I kind of feel guilty booting lo-fi amidst that wonderful 80s tinged synthwave outrun type jam. That was badass. Anyway, welcome everybody to this chat. Man, this has been a long time coming. We initially scheduled this for last year, and now it's finally happening. I think it couldn't be at a better time amidst this shitty bear market. If you look at price action, you know, it's been pretty dreary, and the bear market mentality can wear on you. But I think everybody here at the DAO, and certainly anybody building a DeFi, knows very well that this is the time to build cool stuff. And I think things that will really change the world in the subsequent bear cycle. So yeah, let me introduce myself real quick, and then introduce our guests and kind of outline what we're talking about. If you're new to the Discord, welcome to ShapeShiftDAO Discord. I am Kent. I lead the tokenomics workstream. The discussion today centers around squarely around new DeFi platforms doing cool stuff. So in today's discussion, there's actually 4 such platforms represented. Of course, you have ShapeShift, who aims to make dealing with crypto frictionless and easy in a cross-chain fashion. We also have Lido. We're going to be talking about a little bit about yield generation. We have Clearpool as well. And then sort of the real focus today, and kind of the reason we're having this discussion, is to talk more in depth about a partnership that ShapeShift has announced with Idle Finance that really is part and parcel of our own mission and strategy to make dealing with crypto easy and frictionless. So that said, it looks like we have Rob and Carvas up on stage, and Mateo. Cool. So let's see. I think. Okay, perfect. We have all our representatives here. If there's anybody I missed, please raise your hand. Oh, it looks like we have Biop. Okay, we have a good crew. All right. Well, welcome to the stage, guys. Let's just run through some quick introductions. First, we have Rob. How's it going, man?
Hey Ken, hey guys. Yeah, it's going well, thanks. Have to say I was really quite enjoying that music uh, from Lofi there. Um, but yeah, very happy to be here. Thanks for the invite. Thanks for having me. Um, I'm the co-founder and CEO of Clearpool. My background is in traditional finance, but I've also been in crypto since around 2015. Um, Clearpool is a decentralized, uncollateralized liquidity marketplace, which matches institutional borrowers with a decentralized network of lenders. Anybody can be a lender on Clearpool in our permissionless pools, but the borrowers have to be vetted institutions and include the likes of Volkswagen, Wintermute, and Amber, and many others. Um, we're also proud to have Idle as one of our partner projects, who also participate as one of about 13 Clearpool oracles. Um, excuse me, it's the oracles who price the interest rate curves, which are unique to Clearpool. So we're delighted to have Idle participate in that process. And of course, they've also built the perpetual yield tranches on some of the borrow pools on Clearpool, which can now be accessed via ShapeShift. So yeah, thanks again for having me today. Looking forward to it.
Thanks, Rob. Welcome. And yeah, speaking of Idle, welcome to the DAO, Mateo.
Thanks, Ken, for having me, and proud to be jamming also with these great people and community. Well, I'm Matteo Pandolfi, founder and CEO at Idle Labs. Just to give some background to the audience here, I'm a finance guy. I was working at trade finance and tech and credit risk analysis with Deloitte. Converted then into DeFi native in 2017. Been hammering arbitrage bots and price gas auction on Ethereum with my co-founder since then. And then in 2019, mid 2019, founded Idle when we got our hands over Compound, YDX, first version of Aave, and other DeFi lending protocols, yield protocols, and started building yield aggregation and automation. That also brought me working with world-class teams like Lido and Clearpool here. So again, thanks for having me.
Glad you're here, and so excited to hear more about Idle and talk about the partnership here. Finally, we have Carvis from Lido, which is operating in the wonderful and exciting brave new world of staking derivatives. Welcome, Carvis.
Hi guys, pleasure to be here as well. Yeah, my name is Carves. I work on the liquidity program at Lido, so my focus is to make sure that STETH and the other LSDs that we have for the other POS assets are as liquid as they can be. We have the largest liquidity program in DeFi for more than a year now, and yeah, that has been successful. STETH it's working pretty well. And yeah, I'm here kind of representing the STETH part of that integration, although probably not as core as whatever the two teams between ShapeShift and Idle are going to discuss. But yeah, happy to answer any questions more on the STETH side.
Awesome. Glad you're here. So just to quickly summarize and then briefly outline what we're going to talk about in the hour here. Clearpool and Lido are amongst the yield sources used by Idle that is in turn being integrated into ShapeShift and making it easier for users to access. So we'll talk about just kind of the nature of the partnership here, what this means for Idle users and ShapeShift users. Talk about that. And then kind of hear some more about Idle's functionality, like their best yield function and perpetual yield tranches, which that term alone sounds super degen and DeFi. It's going to be fun. We'll also kind of hear more about like what Clearpool and Lido are doing. They're feeding yield into or their yield sources for Idle. So what are they doing? Really excited to hear more about that. And then we're going to kind of get into a bit of, I think we'll have time for this, but kind of talking about some of the nature of DeFi. Is it overly complex? If it is, how do we abstract away some of the the confusion, make it a little bit more accessible for everyone, and kind of relate that to ShapeShift as well. Here at ShapeShift, we've had a lot of deep discussions about how do we find the right product market fit in the context of DeFi products, and then we'll talk about kind of the future and where things might lead for this partnership. And again, so exciting to have all these projects represented right here. So Matteo, if you wouldn't mind just starting off, the nature of this integration here is that essentially now ShapeShift users have more ways to earn yield on everything from like DAI to USD to Matic. Of course, very much in the ethos of the crypto ethos of permissionless. There's no KYC involved here, no added fees. So yeah, if you wouldn't mind just kind of explaining from your standpoint how you see this partnership and cool aspects of it.
Well, as you said, Kent, well, this partnership, I believe, is the exemplification of the synergies that can be created between different DeFi teams and also sectors. Like, DeFi years has become more and more, like a flourishing range of synergies between teams. So for our case, on one side, we have you guys, this ShapeShift team that has been creating a fantastic product with a great UI UX, easy to use, to onboard a wider, we focus on creating sophisticated DeFi strategies to automate yield generation and risk management. So, well, the main benefits I see here, the junction point, are that in this way, the ShapeShift team doesn't have to stitch together disparate protocols, spend time and resources for countless hours of testing, security audits, peer review, create the automation required to optimize yield or minimize the risk exposure for your users. And then, of course, also keep monitoring the yield market to be sure you are ahead of the curve with what the market is offering at the moment. And well, that's the idle team will do the hard work for it, while ShapeShift team can focus on improving their great product. That one is kind of like the main outcome I'm more proud of from this partnership. And of course, this is why we have a completely also kind of like different personas, but we can merge together to increase the value for both of our customer base.
Wonderful. So it's yeah, kind of the alternative to this would be like the notion of being a full-time DJ, and you're sitting there looking looking at all the different options, looking at dashboards. It's almost like an active trader mentality where you're constantly searching for that best yield, and this really is a way to get rid of a lot of that complexity, but still sort of have that best yield approach. I think we'll hear more about that shortly in terms of specifically that best yield functionality. Question, Matteo, is there a way for idle users to be sort of granular in their approach? And this might kind of overlap into the next section, but like, is it kind of a one size fits all? Like this is where the product or functionality where you're always going to earn the best yield, or can users sort of customize their idle experience around their own risk and reward parameters, like their own risk tolerances, for example?
That's a really great question, because what we're building basically is like multiple layers of this kind of yield abstraction, in the sense that like the best yield mission goal is to actually abstract the complexity from the user. So users that don't want to bother with manual things like rebalancing funds, or they can even benefit from like socialized gas cost for rebalancing, and they want a more passive experience in terms of yield generation. Well, best yield strategy is what they're looking for. Instead, in terms of customization, we have the perpetual yield tranches. Like perpetual yield tranches are capital pools, basically, that allow to create two risk and yield tranched products. We have the senior tranche and the junior tranche. In short, the junior holders receive a higher proportion of the underlying yields, but in exchange for that, they also take on extra smart contract, liquidation, or default risk. It depends on the underlying yield source, of course. On the other side, the senior holders receive a smaller proportion of the underlying yield, but are protected against these kind of risks. Because in a case of a loss, junior liquidity would be used to protect the senior liquidity. So these kind of primitive allow to have a wider array of risk return products and consequently allow users to create their own tailored yield portfolios, while opening also the door to a wider audience compared to, let's call it like naked products, because of its adaptability to the risk profile. So on one side, these allow idle users to create their own yield experience and risk reward ratio, and also gives the team, for example, the idle team, an immense yield playground to work with. Because, well, a clear examples are the tranches based on STIF coming from the collaboration with Lido, or the tranches based on Clearpool, and both got an outstanding traction. And like this kind of yield playground gives the team is really keen to build more on that. So on one side, best yield is a layer of abstraction and simplification of the yield experience. Perpetual yield tranches is a highly customizable product that can be built on different and a lot of different yield sources.
Thanks for explaining that difference. That's a very, I think, powerful sort of thing you guys have done, where you're essentially targeting two kind of market segments and customer groups. One is maybe people who are, obviously they're in crypto, but perhaps they are not. They're not on the DGen side of the spectrum. They just want a frictionless and easy way to earn some yield in a way that feels secure and is secure. I know you guys have gone through a lot of audits on the same token, or the flip side of the digital token. You have people that want to be maybe they don't want to managely or actively manage things like you would say from an active trader perspective, but they do want to customize that risk. Matteo, is the perpetual yield tranche functionality active right now, and is that also available through the ShapeShift partnership?
It is. It should be for most of the perpetual yield tranches right now. Maybe there was one for Estimatic. I'm not completely sure, but yeah, most of the tranches are now available also on ShapeShift.
Awesome. So yeah, let's talk about yield for a minute. And this is like a subject near and dear to our hearts here at the DAO, because we've built some functionality that's similar with both Foxy and something called Yieldies. So essentially, like with Foxy, Fox holders can stake their Fox and receive Foxy tokens, which in turn, via rebasing mechanism, can accrue value. Specifically, the means by which what that happens now is with like token rewards. And then we have Yieldies for potentially doing that with other tokens. The big challenge right now in this bear market, and it's interesting, that arguably DeFi has been in a bear market even longer than crypto in general, because things kind of topped out and after DeFi summer, and it's kind of felt like a grind. But I think one of the exciting things about this talk today is kind of it's highlighting new sources of yield. So this is true of both Clearpool and Lido. I think talking about the under-collateralized approach and the staking derivative approach, respectively, there's basically new sources of yield out there, and you guys, it sounds like, are well positioned to take advantage of that. So that said, I'm curious, Robert, just to hear from you, kind of at a high level, like what does Clearpool do, and what's your approach? I know, with the focus on those under-collateralized loans.
Yeah, sure. So on Clearpool, the yield is a real yield. It's coming directly from the borrower of each of the pools. So and one of the things that we wanted to solve when we designed Clearpool was the problem of over collateralization, which was something that was there in sort of the early days of DeFi. There were many sort of institutional borrowers in the space, who either weren't being served by traditional financial institutions, and then really, when it came to DeFi, only had the option of over collateralized on the likes of Compound and Aave, or or the CeFi approach. So there was nothing really in DeFi that gave them access to uncollateralized liquidity. So we created Clearpool with that problem in mind, but we also wanted to ensure that we gave lenders the ability to manage risk, because the only way really to solve that problem of over-collateralization is to introduce counterparty risk. So on Clearpool, we have institutional borrowers that have to go through an onboarding process, which essentially involves them getting a credit rating from our partner, one of our other partners, which is Credora. Once they've successfully done that, they can launch a pool. The pools, as I mentioned earlier, are permissionless, so anybody can lend. So once you have a pool launched and lenders begin to provide liquidity into that pool, and the borrower can draw down on that liquidity whenever they want. And when they do so, their utilization rate increases. So if we use an example, let's say we have a borrower pool, Wintermute, for example, let's say there's $10 million has been supplied into that pool by multiple different lenders, and then Wintermute starts to borrow from that $10 million. Let's say they draw down 8 million, they'll be at 80% utilization, and then there's a corresponding interest rate on the utilization curve at 80%. So let's say that would be 10%. Now, the interest rate curve itself is very unique. It's something that we developed, and it has a very distinctive shape, which it gets from a cosine function. And this means that you actually find the lowest interest rate on the curve at 85% utilization. So it incentivizes borrowers to be around that level. So in our example, Wintermute would probably be drawing down around 8.5 million of the 10 million that's in the pool. What that means is that as a lender, one of the lenders in that pool, you'd be able to withdraw your liquidity at any time. Let's say you were lending $100,000 into that pool, you would be able to withdraw that at any time, from the 15% that's sort of remaining within the pool. So it's designed really to allow lenders to do that. So there's no lock-in, you're not locked in, for any specific period of time. If you have a scenario where many lenders try to withdraw liquidity at the same time, of course, it just pushes the utilization rate up for the borrower. And when that happens, the interest rate starts to increase as well. So above 85%, the interest rate starts to rise quite steeply. And then you can have sort of two dynamics. Either the higher interest rate attracts new liquidity into the pool, so new lenders will come and farm that additional yield, or the borrower can repay liquidity into the pool to bring the utilization back down to the optimal level, around 85%, and therefore be borrowing once again at the lowest rate. If you, in extreme circumstances like we had during FTX, you will have pretty much every lender looking to withdraw liquidity at the same time. This will push the pool right up to 99% utilization. In that scenario, the borrower would then have 5 days to bring the utilization back below 95% threshold level in order to avoid a default. So what we saw during that extreme volatility was this happened to pretty much every pool. Borrowers had to repay, but then immediately lenders would look to withdraw that liquidity once again. And what this incentivized was really for borrowers to fully repay their pools, which meant that on Clearpool within days of the FTX bankruptcy announcement, all of the lenders were able to get their liquidity out, which is really really unique in the space. Especially when you compare it to even other DeFi protocols in the uncollateralized space where you're sort of locked in for term periods. But also, if you're lending on other platforms, of course, where you're locked into term loans, you're kind of being exposed, to growing risk. Whereas on Clearpool, lenders were able to withdraw, very quickly. So the protocol really is kind of driven by that supply and demand dynamic of the borrowers and the lenders. There's no way, that we can intervene in that process, but that all of the incentive mechanisms really incentivize that behavior, so that in those circumstances, liquidity is available. So getting back to the point, the lenders are able to pick which of the borrowers they want to lend to, and the yield is coming directly from that borrower. So if you're lending USDC, you are receiving USDC yield. Typically on Clearpool, the yields have been between around sort of 9 and 12% since we launched last March. And then you can also get an additional kicker in the native token C pool on top of that. So it sort of boosts the yield up, to by another sort of 1 or 2% usually. And then those rewards can be staked also on Clearpool. Staking essentially helps to secure the interest rate pricing mechanism I also mentioned in the introduction, Clearpool oracles. IDLE is one of those. The oracles price the interest rate curves, and by staking, you essentially helping to sort of secure that mechanism. So there are real yields available, and that is sort of that's how Clearpool works.
Thank you for that overview. Pardon my French, but this is really fucking cool. I'm not aware of anything that has existed quite like this yet in the DeFi space, where there's this sort of nexus of permissionless lending. Anybody can jump in and do that. No KYC required. But the counterparty in that case, on the opposite side of the table, is institutional borrowers who have also gone through that credit rating process. We had the opportunity and the pleasure of dealing with Credora a month or two ago in the context of a longer term bond offering that ShapeShift did. And specifically what Credora at the time was trying to do is kind of get their head around the unique attributes of DAOs. Of course, we don't have a balance sheet in the same way that a traditional company would, but we do have all this wonderful on-chain, transparent, immutable data, and we have a lot of different dashboards for that. So it was kind of cool to talk to them about just the nature of that and how it differs, and what analogs might apply for traditional terms. It's really cool to see that they're plugged in to you guys, because it feels like a perfect fit there. Robert, in the context of IDLE and your guys' integration, and then via that integration onward to ShapeShift users via this partnership, but you mentioned that lenders could sort of pick the borrower or the borrowing pool. Does IDLE automate that process, or can users in IDLE actually get that granular? It sounds like maybe IDLE goes through that extra step of finding that maybe the best yield across the borrowers. Or could you and maybe you and or Matteo kind of speak to that partnership angle between you guys and how that functionality works?
Yeah, sure. So I think this is actually an important point, because I mentioned earlier about risk management. So that really begins with being able to choose which borrower you want to lend to. There are other options available where you lend into a sort of a generic pool, and then there'd be somebody else essentially managing that pool of liquidity. Whereas on Clearpool, you do get to make that decision yourself. So you can pick the borrower, and that's really where the risk management process begins. The cool thing about the integration with IDLE is that you're then able to not only pick the borrower, but then also select, a trench. Do you want to go into the senior trench or the junior trench? Do you want to take more risk or less risk? So it gives you, another layer of optionality in terms of risk management. So I think the perpetual yield trenches were implemented on 2 of our pools so far. I think Matteo can talk about that. We hope that as we move forward with the partnership, that will be available on all of the pools, so that additional layer of risk management optionality will exist on all of the pools.
Exactly, as Rob mentioned, I mean, that's exactly the first goal that we got with when we were looking at the Clearpool under collateralized pools, to give this kind of risk-adjusted access and to get to a wider audience in terms of risk profile. And actually, Kent, you mentioned that, like you said, do we provide granularity or also automation? So the first step for us was to provide granularity while providing also risk management via the senior and junior tranches. But actually, it's quite cool. It's something that we are thinking and preparing to iterate for. Like as Rob said, the potential is to integrate any of the different pools that Clearpool has. But also on top of that, you can build an automation with the best yield infrastructure. So basically, you have an aggregation of different senior or junior tranches. You can even think about where if, like, for example, Clearpool expands into other markets other than the institutional market, but starts to provide loans on different kind of borrowers. You can think also about an automation where you create a basket of like a sort of vertical, a thematic basket of different Clearpool pools that are adjusted for the risk, so for the senior and the junior side. So definitely we have a lot of things and synergies that we can build more in the future with Clearpool.
Awesome. Yeah, I think this is also the sort of thing. It sounds like once you start to use this functionality, and especially in the context of these different easier to use interfaces, it just at least in my experience, there's always kind of that light bulb moment where as you play around with something, you might have like a theoretical understanding of kind of what's happening there or what the benefit is, but then once you use it, it really clicks. Back in the day, it was as simple as sending somebody Bitcoin or receiving it, and you kind of have that aha moment. And these days, it's like, oh wow, I'm earning yield in a very easy fashion, but I can customize it in different ways. Yeah, turning to one more source of yield here, and again, these are, I think the thing to emphasize here, one thing to emphasize is these are sort of relatively new sources of yield. We've come so far beyond the kind of naive liquidity mining of 2020, and that turned out to not really be sustainable. This is the era of protocol-owned liquidity, and we've moved kind of beyond those simplistic mechanisms that existed back then. These are new sources of yield. So one of the most exciting sources of yield in my mind these days is staking, and specifically because these yields can be pretty noteworthy. Not necessarily maybe into the double digits, but you can get good yield in a fairly risk managed fashion because most of those risks are just at the protocol level. We first saw this heavily, of course, in the Cosmos space with Cosmos staking. But with the advent of the Beacon chain and Ethereum staking, and of course, now that the merge has actually happened, things have gotten so much more interesting. So Lido has been one of the projects on the vanguard of this, working specifically in the context of like staking derivatives. So Carvis, I'm a total fan of Lido. It's great to have you here. I hope I did a little bit of justice to Lido, but if you could just kind of provide an overview of what you guys do and maybe the benefits of liquid staking.
Yeah, totally. I think you were super fair. So, as you mentioned, I'm also a very big fan of sustainable yield on chain. And I think that right now, and probably going forward, Ethereum staking yield is going to be the primary source of yield that we have in DeFi, and it basically percolates from the staking itself into many different apps that we can go over. But the main thing of liquid staking is that it solves three problems. So kind of like pulling it to the beginning of all of this. If people wanted to stake ETH directly on chain, they would have three problems that are pretty much solved in a liquid staking solution like Lido and others. The main one is that they would have to stake in increments of 32 ETH. So if they have less than 32 ETH, or even if they have more, but not a multiple of that, 64, whatever, then they would just not be able to stake a very significant part of their ETH, or none at all, if they were large, small holders. So that's one. The second problem is that if people stake directly, like running their own validator, for example, then they basically lose access to that capital for other use cases. This is one of the big unlocks of LSDs, which is that you are staking, you are securing the network, and you are receiving staking yield, but you're also able to access that capital and unlock the capital efficiency that capital has for other use cases, the main one being collateral. And then the third thing that gives basically the L in LSD is that it's a liquid position instead of a locked position. So anyone that would stake directly on the Beacon chain running their own validator infrastructure basically can only expect to withdraw that after the next hard fork of Ethereum that Shanghai updates. It's now scheduled to or at least indicated towards March. But even then, there's still going to be a queue to withdraw, which depending on the demand to withdraw, the demand to enter, etc., can still take a lot of time. And if you stake via Lido or another liquid staking protocol, you just have access to instant liquidity on those positions, the ETH that stake, via secondary markets, which is also a big unlock. And so the way all of these three problems get solved is that people stake towards Lido. It basically gets pooled. Lido distributes that stake across many, actually tens of validators, or not validators, but professional node operator companies that have clear track records of doing a good job of keeping high uptime, not taking slash, etc. And then people just have a tokenized representation of that position. That's called a seat in this case, where it's a simple ERC20. They can just use it across DeFi in most places. So, for example, right now it's the cheapest way to mint DAI. It's against SETH, even cheaper than against ETH, for example. One of the number one TVL asset used as collateral on Aave is also SETH, so that's also a pretty popular strategy. The number one balancer pool, the number one curve pool is also for SETH or wrapped stake ETH, which is the wrapper on top of it. So it's very, very useful in DeFi. It's one of the main collaterals that's now being used. And yeah, basically the tokenization of the stake position is what unlocks those three things. So to recap, you can stake any amount. You're not locked to multiples of 32. So if you want to stake 0.1 up to any amount, that's perfectly feasible. Secondly, you retain liquidity on that position. 32 ETH is not that small of a dollar amount, right? So it's kind of a big opportunity cost for anyone to just stake directly and know that they won't be able to access that capital for an unpredictable amount of time in the future. And that's where our liquidity program works, by incentivizing very large pools in DeFi that allow users to exit those amounts whenever they want, and give them the confidence and the assurance that they would have that option going forward indefinitely. And then the third thing is basically unlocking the capital efficiency and the collateral use case of those assets, which is also a big unlock. And yeah, like you mentioned, it's a very big source of yield right now. For example, for SETH, there's around, I think at current prices should be around 6 or 7 billion in USD denominated TVL, which is very significant, yielding around 5%. So the cool thing, and the thing that can be useful, for example, for Idle like it is now, or for other integrations, is that anyone can build on top of SETH and then just leverage that yield in different scenarios. For example, Idle separating it into senior and junior tranches, the strategies that I mentioned of levering up on Aave, or depositing it into LP positions, minting DAI against Maker vaults, etc. And basically, it's going to be, like you mentioned, Kent, one of the underlying and the deepest down in the stack sources of yield that then can just percolate across various different defined integrations.
Oh, thanks for the overview. I have a couple questions. It's just such a cool, staking alone is interesting, and I think just especially post merge, it's a very powerful thing. But the value propositions that you've articulated here, just independently, are pretty powerful. Like in terms of making it more accessible, sort of democratizing staking. Another one for me is like I've considered running a node before, but I don't have the network security chops. I don't know how to set up a firewall. It's like I don't trust myself really to do that. And at the same time, I don't want to stake with as much respect as I have for Coinbase. I don't want to stake with a centralized service. So one question is, let's say I'm a bit of a decentralization maxi, and I want to contribute to the decentralization of the beacon chain. The nodes that are run through Lido, you mentioned there's an amount of specific amount of nodes. Roughly, how many nodes are there, and are those all sort of independent? Are they all their own independent node operators, all contributing to Lido?
Yeah. So basically, there are companies, right, that have that professional infrastructure that you mentioned in place, and that have pretty good track records. And then each of them just gets a small allocation of the total ETH that's staked via Lido. There's basically a process where new companies can apply to become a part of the node operator set, like it's called. Basically the mentions towards those companies is in our website, more towards the bottom part. So if anyone wants to check out who they are, they can just go there. Lido is also working, and one of the priorities in terms of development work, it's to work towards permissionless validation. So not having to be onboarded or whitelisted as into the node operator set. So that's going to be a big step. And yeah, that's kind of like the overview on the ways that all of these validators get run. An important point here that it's like very key to have in mind is that, like you mentioned, the main alternatives to Lido would be centralized ways of staking, right? So like the large players in Ethereum staking are, for example, the Sexes and then Lido, right? And it's obviously much better, and I'm super biased, of course, but obviously much better to have a DAO run that fully on chain and have much less trust assumptions than we would have with just basically a company or a set of individuals running that. So yeah, that's the main point. Another, if I may, another interesting point here. Actually, I lost the last point that I wanted to make, but it will come back. I'm not sure if you have any follow-up questions on that first point.
One more follow-up question. We have the Shanghai upgrade coming, and for those who are unfamiliar, this will unlock withdrawal functionality from the beacon chain. There's been this common sort of myth among Bitcoin maxis that you can't take your money out of the beacon chain, and it's a mess. In fact, it's always been intended that functionality would be enabled, and it's going to be enabled very soon. Does that have sort of a big impact on both maybe your overall business model, but also potentially maybe the resulting yields? Are you expecting yields to go up or down, at least temporarily, in response to that enabling of withdrawal?
Yeah, I'll answer that. It just popped back into my mind the previous point that I had forgotten, which is that one of the main reasons why Lido onboards professionals and professional infrastructure to validate is that there's the phenomenon of slashing, right, in Ethereum staking, which is if you wanted to run your own validator, if there's a specific time of downtime or a specific, if you propose wrong blocks, etc., you can just get slashed on the amount of ETH that you have, and slashing is socialized inside of SETH. So if there was a slashing event, basically all of the other holders of SETH would also get cut a little bit, and that's basically one of the main reasons why it's super important to see a track record and many parameters, and why we have what's called a node operator management team, our NOM team, that looks at all of that and leads the onboardings for those infrastructure players. So that's just the last point from the previous conversation, why we have to work with professional infrastructure to avoid having large amounts of ETH slashed. And regarding withdrawals, my personal view, not really speaking for Lido, my personal view is that right now, if we look at different POS chains, Matic POS or Solana or Ethereum, etc., Ethereum is actually one of the POS chains that has the least percentage of the token staked, right? Like on Matic, on Solana, on all of the others, the percentage of that native token that's staked, it's much, much higher than for ETH. And one of the main dynamic to all of the other POS chains where we see a lot of the native tokens get staked, which does make sense, right? If we think about it, if you are a large Ethereum holder and you know that you cannot withdraw or unstake directly now, basically your risk that you're taking or your opportunity cost of staking is also higher. So post Shanghai, post hard fork, whenever we have withdrawals working, I think it's just going to be a catalyst to have a lot of new staking in the midterm and in the long term as well. So that's a very exciting thing. If we see that, basically some of the yield will get diluted a bit, which it just parts of how Ethereum pays yield for validating purposes. So yeah, that's something that can happen in the short term. Basically, the market for liquid staking is also can get a bit reshuffled, right? Because up until now, if someone stakes into some provider of liquid staking, they cannot withdraw, they can only sell. So it's not like a perfect competition-enabled market, right? Where it's not people cannot just unstake and move towards another service, but it's almost like that because there are very liquid secondary markets which allow people to exit. So people are super free to just exit STETH or enter into STETH from all of the others, or even just validate themselves. So I don't think there's going to be too big of a reshuffling there because the secondary markets work now for that and would absorb the demand for that right now. So I still think there can be some short-term shenanigans happening there where people like long-term Ethereum stakers and stake probably more on the side of people that are running their own infra, because again, the people that hold LSDs have the option to exit, basically have had that option since ever. It's more like the ones that don't have that option, the ones that are not in liquid staking, that may have pent up demand to exit. But over the midterm to the long term, I think it's just going to be very, very good for the amount of ETH that participates in validating.
Yeah, it should spike up quickly. I'm really excited to see how this works out, and of course, you know, the overall security of the network increases as more ETH is staked. I guess considering all things considered equal with respect to price. Let's see. Before I forget, so there are a few absolute POAP maniacs in the stage chat wondering when if this will have a POAP, this event. Yes, indeed, there is a POAP. Just hang on till the end of the call, and I will provide the code to access and the means by which you can access that fabulous POAP. Because hey, POAPs are awesome. Let's see. I just want to quickly explore the integration between Lido and Idle. And then maybe we can wrap up with some interesting sort of questions that I think will also resonate with ShapeShift users and contributors. But Matteo and Carvis, if you can just kind of describe maybe briefly the nature of the integration with Idle. It sounds like, okay, you have this nice source of yield coming from the beacon chain and Lido, and then via Idle, is this one of the options, or is it just is it one of the things that best yield might plug into?
So, well, yeah, in the context for like perpetual tranches and STETH, the first instance of this kind of strategy was with like plugging senior and junior tranches directly into STETH. That's, as Carvas mentioned, also cover the slashing risk, the eventual slashing risk for Lido, which might not be really tangible, but it's still present, and especially to onboard like new users that want to still stake without using LSD, they can go with the senior tranche, while stakers and users that have more confidence into Lido can go just with the junior tranches. That's the first iteration that we got for this product. We got a pretty good traction with also the help of the Lido team. I think that, and Carvas mentioned also this, pretty exciting going down the road because, as Carvas said, STEF is widely used as collateral. It's one of the most used collaterals. You can build like many different strategies, both to like leverage STETH, to also leverage yield, to provide liquidity into curve, balancer pools. So I believe that in going further with the perpetual tranches applications on top of STETH, we will definitely see some leveraged strategies. So using STETH as collateral, which means basically to add another kind of like covered risk, because you have still the base slashing risk, but I'm pretty sure that like the Lido team, looking at the track record, has been doing great work in terms to reduce and mitigate that. But going further for the PYTs, the perpetual tranches on top of ST, I see the most exciting application being like using leveraged strategies on top of STETH to, of course, provide a higher yield, and with senior and junior tranches provide a layer of coverage for the senior for the liquidation risk, for example, as being used as collateral. So the first iteration has been already successful with STETH and with the help of Lido team. And going further, I see a bright future for this kind of integration using also more sophisticated strategies on top of STETH.
Awesome. Yeah, this integration sounds really really like a win-win for everyone involved, from the user down to the respective parties there. Let's see here. We have 7 minutes left. We may need be able to go over a little bit. I don't want to assume that, though. Let's assume a hard stop. But I just want to wrap up with a little bit of kind of a forward-looking question or analysis, and it's like very top of mind right now too, in terms of just like, okay, we're at an interesting point in the evolution of crypto, and especially DeFi. Here at the DAO, we've talked a lot internally about finding the right product market fit. Of course, it's our role we see as like helping users understand and kind of get through this DeFi complexity, really remove those barriers to entry to these complex products that at first blush might feel super complicated to the uninitiated or the I don't want to say uneducated, that sounds mean, but like somebody who's not familiar with leverage assets or risk crunching, things like that. It seems like all the projects present here today kind of share that goal. Let's hear maybe from Rob about this question, but how do you guys sort of approach finding that right product market fit? Kind of who do you see as maybe your different customer groups moving forward, and how are you guys aiming to just sort of meet their needs in this kind of fast evolving industry we call crypto?
Yeah, so I think it depends. If you're looking at it from the borrower perspective, as we already talked about, we're only looking at certain types of institutions. There are a number of institutions that we've been working with, we've been speaking to for some time now, who who really love this space, love the innovation that we have in those permissionless pools. But at the same time, these kind of more sort of traditional financial institutions, that they have the need to have sort of fully KYC lenders, so they need to have visibility on who their lenders are. So we're building, a product. We've actually built a product which is specifically for that sort of profile of borrower. It's called Clearpool Prime. Going to be launched this quarter. And essentially what that is like a fully sort of KYC AML compliant ecosystem. So all of the institutions that are in there have to go through this process of onboarding. But once they're in there, then they can create a borrower pool These pools will be sort of fixed size, fixed tenor, fixed rate. So they select the asset they want to borrow, the rate they want to pay, the size and the tenor of the pool, and then they can select from all of the other participants that are whitelisted who they want to give access to. Those guys would then receive like an RFQ type notification telling them that this pool has been launched and inviting them to fund it. And then there's all sorts of other sort of functionality in there, like the ability to roll loans and call loans and stuff like that. So this has been built, for institutions, specifically, those type of institutions that still have that sort of KYC, AML compliant. They need that compliant access. On the permissionless side, on the lending side, as I said, anybody can be a lender. So we really, want to attract as many different profiles as possible because it's very important for those pools to have diversification. This is something that is attractive to the borrowers. Always to have sort of diversified pool of liquidity is more desirable for them. The ultimate goal there is that the more lenders we have in those pools, the more diversification you have, and then the less likely you are to have those scenarios where if a few lenders withdraw liquidity, it doesn't really sort of like send utilization spiking. So we think that the concept of lending is quite simple to most people. So I think one of your points was the sort of like complexity of some of the DeFi protocols. I think Clearpool and the core concept it should be quite most people to understand. And therefore we really think that it's sort of it's something that anybody can use. And I think really it just comes down to the question is what are you trying to do? So as you're looking at sort of DeFi in general, if you're looking to get a yield on your stable coins, then maybe Clearpool is the place for you. But if you're more risk averse, then you could go to idle and go in the senior trench, have a slightly lower yield but more protection, or you can go to compound and do the over collateralized thing and have a even smaller yield but more protection. But if you're if you find yourself on an option vault protocol and you don't know you've never traded options, then you have to kind of ask yourself, what are you doing there in the first place? What is it that you're trying to do? So that I think is something that I guess isn't financial advice, but I think anybody sort of looking to earn a yield in DeFi should first of all make sure that they understand the concepts, the core concepts of what the protocol is doing.
Absolutely, that educational component can be so important sometimes. Let's see, real quick here for the people wanting the PO app. Okay, it's time to announce that. Just go to well, you need to download the PO app. So download that, and then the secret phrase, pardon me, is shape-idle-shift. I believe it might auto-populate those 3 line breaks or dashes there. Let me post that wonderful secret phrase into the stage chat. I was given a capital S here. I believe that may be case sensitive or perhaps not, but that's going to be your jam. Let's see, we're at 1. I have one really quick question for you guys, and then wanted to give the last word to you, Matteo, since this is an idle partnership and we're just really excited about all this. It's been a great chat, but will you gentlemen be attending ETH Denver? We have many Foxes that will be attending. Many of us are actually in Denver, and it's always a fun event. Just curious if you guys will be here.
Unfortunately, for this year, at least now, no, we won't be attending. Unfortunately, because I've been in Denver a couple of years ago, I guess, and it's a fantastic vibe to be there. Fortunately, not, but hopefully there will be other occasion to meet in real life during this year.
Amen to that. There's always more conferences. Rob and Carvis, how about you guys?
We'll definitely have somebody there. When is it?
The core of it is like first week of March, sort of like the 2nd through the 5th ish. Although the prior week there's going to be stuff going on as well.
I think we'll definitely have somebody there. I'd love to make it, and if I do, I'll let you know. But yeah, one of our guys will be there, I'm sure.
Very cool.
Yeah, I'll probably not be going to ETH Denver, but I know that plenty of Lido contributors are going to be there, so feel free to hit them up in person there.
Awesome. Yeah, I always see Lido reps at or people at conferences. You guys always roll deep. So yeah, just kind of closing it out, Matteo. I'm curious. Maybe if we could just kind of think about the future. Kind of where do you see DeFi in a year? Just kind of projecting things forward. I know it's always notoriously hard to make any sort of like accurate predictions in crypto, but kind of where do you see things heading? You guys very much share our goal at ShapeShift of trying to really remove these barriers to entry to things like earning yield. Curious to hear your thoughts on kind of more of a forward-looking basis.
Yep. So as you said, it's pretty difficult to make this kind of prediction with DeFi because it's a rapidly growing market, and there might be different areas of development during this year. But like for this year, I see kind of like three main areas where DeFi can really grow. First one is kind of like your area, ShapeShift area, is kind of like simplify to the bone the experience for users, like kind of like it's similar to what like for years crypto has embraced the narrative that it can bank the unbanked, and actually it's true. Like a crypto wallet is a bank account for anyone with an internet connection. DeFi savings account is kind of like 10 times better. They are global and gated, with the progression of like more internet connections spread around the world. We can allow anyone to easily open a savings account. So like as I said, like I believe you guys are killing on that side, and while I would say it's not really clear right now what the catalyst could be for that, I'm quite optimistic because like I can see kind of a mixture of a trust gap to be filled by a combination of user-friendly experience for complex products, word of mouth, good communication and education, and some foremost kind of protection for users could be something that can drive more adoption on that kind of area. The second area that I see is kind of like the institutional adoption. We saw that quite a lot in 2021, and I do think that there's still kind of a glass ceiling before the entire Wall Street wholesale pivots to DeFi. The efficiency and lower operational cost is clear compared to TradFi. I think here, and especially in 2023, the connection and proactiveness of DeFi teams, institutionals, and even regulators is paramount, in the sense that without regulation that makes sense, that in my personal opinion should apply at a high level, at a application level, meaning businesses operating and user facing software provide access to the protocol should find a regulation that makes sense rather than the actual layer protocol to the underlying blockchain, smart contracts, and network that provide the internet with this kind of native functionality that DeFi is giving. And in this sense, if teams and regulators get to be proactive and create this kind of regulation that makes sense, I think that we can witness the initiation of a new wave of institutional adoption and product market fit for DeFi. Third and last one, in my opinion, is the kind of like real DeFi economy. This is, I would say, kind of like a quite exciting path to get to evolve the DeFi market, which like put more simply means a real world economy built on crypto rails. This is kind of an economy that is not in service only of digital assets, which DeFi already mastered, but rather related to real goods and services, who has an economic layer in that is coordinated on chain, which, for example, Clearpool is an example of this. and personally following closely products like that brings real world assets on chain, build credit scores, and can expand under collateralized loans even more, or allow to collateralize these even like your wage, your future cash flow on chain, and all on crypto rails. So more generally, I think that DeFi can become the de facto approach for hosting most of the financiable assets. And so, well, as I said at the beginning, given the pace of innovation and growth that we saw in the last years, it's quite difficult to have a clear prediction of that. But I'm quite optimistic by any or all of these three narratives coming to fruition. And we're all here, from you guys at ShapeShift to Clearpool, Lido, and Asset Idol. We're all here to build them.
Well said. I think here at ShapeShift, we share your optimism for sure. It's an uncertain world. There's scaling challenges. Although lately, I think that's improved. It's more like a UX challenge. There's regulatory challenges, of course, but over the long run, this feels inevitable because it's just the functionality and the sort of the value prop for end users is just so much better, and as are the crypto economics behind everything. So gosh, yeah, good stuff. On that note, guys, I think we can close it out. I want to say thank you very much to Rob and Matteo. Carvis had to leave, but thank you very much for Carvis and Lido for repping as well. If you guys are interested in any of these protocols, check them out. There's so much going on behind the scenes with all these, and really cool teams. And of course, with respect to the ShapeShift and Idle integration, go in there and check it out yourself. Again, this is really moving towards that idea and that central vision of making DeFi and crypto more accessible, because at some point in the not too distant future, everybody around the world is going to use this stuff, just like everybody who touches the internet these days. We're early, but we're headed in the right direction. So thank you guys again, and have a wonderful weekend. Yeah, we have a stage chat going on. If anybody wants, it looks like there aren't any remaining questions, but yeah, appreciate your time, guys.
Thank you, Ken, for having me, and thanks also for the entire ShapeShift community. Really excited to jam here and had a great time.
Likewise, thanks a lot for having me.
Awesome. All right, take care, guys. Thank you.
Cheers.